Hello students. So let's start with the new session for a new topic, and this is CACS Pushkaraj Vishnu Doshi. We are together for the ICWA final paper 20A, which is about special strategic performance management and business valuations, and in short called as Spm&Bv. And we have been together for almost entire subject. In that we have finished with 7 modules. Currently we are undergoing through 8 module, and in today's session 8 module is all about valuation of assets and liabilities. And in today's session I am covering chapter number 7, which is about value added, economic value added and market value added. So these are 3 different kind of concepts which are predominantly used while business valuation is being done. And let's deep dive into the topic. Again, as I said in the earlier session also, these are very small, specific to assets valuation chapters, and therefore they are hardly in the subject in the syllabus also, and in the study material also hardly there are not more than 5 pages of chapter these are. So let's begin. So value added. So general definition by value added refers to the additional features or economic value of a company that is added. Just a second. So value added refers to the additional features or economic value a company adds to its products and services to attract more customers and increase revenue and profits. So that's what value addition per se means: additional features or economic value a company adds to its products or services to attract more customers and thereby increase revenue and profits. So that's value addition. So what is that increase in value that has happened, and the efforts that are being put by the organization or the company into its products and service to add value to it. So in corporate finance context, in finance, value added focuses on enhancing shareholder value through strategic financial actions. So such financial actions which in a way will translate into increase in the shareholder value is what meant by value added. Determinants of value typically in such situation is the company actions can influence value by affecting cash flows from existing assets, growth rates, cost of capital, duration of the growth period. These are the 4 factors or determinants of value, and therefore accordingly the valuation will be determined, or company's actions will influence the value by these factors. Net present value. So this measures value created above the cost of capital. So net present value measures value created above the cost of capital. Investing in positive net present value projects increases company value, and therefore negative NPV projects reduce value. So that's how positive NPV projects increase in company value, and negative NPV reflects projects reduces the value. So in continuation with value added concept, market capitalization is considered as an indicator. So an increase in market capitalization implies value creation. A decline in stock prices implies value destruction. So modern value creation tools are typically in case of value added concept are market value added and economic value added. So economic value added and market value added are newer methods or modern value creation methods, tools. These tools are simpler and rely less on market estimates and assumptions. So let's understand these 2 tools, economic value added. So economic value added concept and definition: EVA, that is economic value added, is a financial performance measure that captures the true economic profit of an enterprise. Now this concept was developed by Stern Stewart and company, therefore it is trademark. The EVA concept is trademark, is the metric most directly linked to shareholder value creation, and it reflects profit after deducting the cost of capital, the return required by shareholders and lenders. Formula wise, EVA is equal to NOPAT, that is net operating profit after tax, minus capital employed into cost of capital, where NOPAT is the net operating profit after tax, operating income into 1 minus tax rate, and capital employed is equal to total funds invested in the business, and cost of capital is the weighted average cost of capital, that is WACC. So this is the concept of EVA. Furthermore, how a NOPAT is to be calculated, let's see, starting with operating profit after depreciation and amortization. Add to it implied interest on operating leases and goodwill amortization, less reduce from it cash operating taxes derived from income tax expense, adjustments like deferred taxes, tax benefits from interest and leases, less taxes on non-operating income. Then comes the concept of capital employed. So these are the calculation components which are involved in EVA, which we are discussing. So capital employed includes net working capital excluding interest bearing liabilities, net plant property and equipment, goodwill including accumulated amortization, other assets, present value of operating leases. Alternative formula for capital employed is equal to equity plus preference capital plus long-term debt. Then comes the concept of cost of capital, which is important component of calculation of EVA. Cost of capital is also called as WACC, that is weighted average cost of capital. Weighted average cost of debt and cost of equity is WACC. So debt portion into after tax cost of debt, and equity portion into cost of equity based on capital asset pricing model, that is CAPM. Thus cost of equity is equal to risk free rate plus beta into market risk premium. Final EVA computation typically then formula wise is EVA is equal to NOPAT minus capital employed into WACC, which indicates how much value so EV is equal to NOPAT minus capital employed into WACC, which indicates how much value a company is creating or destroying above the required return on capital. The terminal value estimation for long-term projections is terminal value is equal to EVA divided by WACC minus net sales growth rate. And capital invested, which is the alternative calculation, is capital invested is equal to NOPAT minus gross capex minus change in working capital plus increase in non-interest bearing liabilities minus total depreciation. So the capital invested, which is the alternative calculation for EVA, is capital invested is equal to NOPAT minus gross capex minus change in working capital plus increase in non-interest bearing liabilities minus total depreciation divided by net sales growth into NOPAT. So that's the formula as an alternative method to calculate EVA, which means capital invested. Now let's see the second concept of value added, which is market value added, MVA. Concept and definition: market value added measures the difference between market value of a firm and the capital invested by shareholders. Now this indicates whether a company has created or destroyed value over time. Formula wise, MVA is equal to market value of equity capital minus capital employed. Interpretation wise, positive MVA means firm has created value and market value exceeds invested capital. Negative MVA reflects firm has destroyed value and market value is less than the invested capital. Let's see the use and implication of MVA. So MVA is used to assess if management's actions since inception have created shareholder wealth at all, and higher MVA reflects better management performance and stronger shareholder returns, and negative MVA suggests poor investment decisions or underperformance. Strategic focus: the goal should be to maximize MVA and not just the firm's total value. Simply increasing capital investment can raise firm value without genuinely creating wealth. Now let's understand the relationship between EVA and MVA and the difference also accordingly. So core relationship, market value of a firm reflects expected EVA from existing assets and expected EVA from future projects. So impact of EVA on market value is if actual EVA is less than expected EVA, then market value may decline even if EVA itself is positive or increasing. It indicates that market expectations significantly influence valuation outcomes. Interpretation for corporate finance, increasing EVA is still valuable even if it falls short of expectations, and delivering some EVA is better than none even if it's below expectations. Implication for high growth firms, if in firms with high anticipated growth and excess returns, the correlation between EVA and market value is weaker, and market value and market already prices in strong expectations, so small disappointments can reduce value. Investment strategies insight. So EVA based investment strategies must be carefully designed, especially for firms with high expectations built into their stock price, and to avoid overpaying or for expected future value that may not materialize. Yeah, so with this we come to an end of the chapter. As I said, it's a very small chapter, and let's have as a matter of practice that I have been following in the sessions, let's recap what we have covered in today's session quickly. So we saw value added. In that value added, we saw the general definition. Value added refers to the additional features or economic value a company adds to its products or services to attract more customers and increase revenue and profits. In corporate finance context, in finance, value added focuses on enhancing shareholder value through strategic financial actions, and determinants of value includes company actions can influence value by affecting cash flows from existing assets, growth rates, cost of capital, and duration of the growth period. Net present value measures value created above the cost of capital. Investing in positive net profit, net present value projects increases company value, whereas negative NPV projects reduce value. Then we saw how market capitalization is an indicator of value added. An increase in market capitalization implies value creation. In general, a decline in stock prices implies value destruction. Modern value creation tools are economic value added and market value added, which are the newer methods. These tools are simpler and rely less on market estimates and assumptions. Now let's see the both. Then we saw both EVA and MVA concepts. EVA per se, economic value added, which is a trademark of Stern, Stewart and Company. EVA is a financial performance measure that captures the true economic profit of an enterprise. Developed by Stern, Stewart and Company, EVA is the metric most directly linked to shareholder value creation. It reflects profit after deducting the cost of capital, the return required by shareholders and lenders. Formula wise, EVA is equal to NOPAT minus capital employed into cost of capital, where NOPAT, that is net operating profit after tax, is equal to operating income into 1 minus tax rate. So capital employed is equal to total funds invested in the business, and cost of capital is equal to weighted average cost of capital, that is WACC. Calculation components. So calculation components includes NOPAT calculation, start with operating profit after depreciation and amortization, add to it implied interest on operating leases and goodwill amortization, less cash operating taxes derived from income tax expense, adjustments like deferred taxes, tax benefits from interest and leases, less taxes on non-operating income. Capital employed includes net of working capital excluding interest-bearing liabilities, net plant property and equipment, goodwill including accumulated amortization, other assets, present value of operating leases. Alternative formula is capital employed is equal to equity plus preference capital plus long-term debt. Then another calculation component is the WACC, that is cost of capital, weighted average cost of capital, which means weighted average cost of debt and cost of equity. So the debt portion into after tax cost of debt and equity portion into cost of equity based on CAPM. So cost of equity is equal to risk-free rate plus beta into market risk premium. Then final EVA computation basically then involves EVA is equal to NOPAT minus capital employed into WACC, and this indicates how much value a company is creating or destroying above the required return on capital. Terminal value estimation for long-term projections includes terminal value equal to EVA divided by WACC, weighted average cost of capital, minus net sales growth rate. So therefore capital invested, that is alternative calculation. So capital invested is equal to NOPAT minus gross capex minus change in working capital plus increase in non-interest bearing liabilities minus total depreciation divided by net sales growth into NOPAT. So this is the formula which is used for capital invested, which is the alternative calculation for economic value added. Then we saw the market value added concept and definition. So MVA measures the difference between market value of a firm and the capital invested by shareholders. It indicates whether a company has created or destroyed value over time. Formula MVA is equal to market value of equity capital minus capital employed. Interpretation positive MVA is equal to firm has, it means firm has created value and market value exceeds invested capital, and negative MVA is that firm has destroyed value, so market value is less than the invested capital. Then we saw the use and implication of MVA used to assess if management's actions since inception have created shareholder value. Higher MVA reflects better management performance and stronger shareholder wealth. Higher MVA reflects better management performance and stronger shareholder returns. Negative MVA suggests poor investment decisions or underperformance. Then we saw the strategic focus. So the goal should be to maximize MVA, not just the firm's total value. And simply increasing capital investment can raise firm value, but genuinely creating without genuinely creating wealth. So then we saw the relationship between EVA and MVA. So the core relationship is that market value of a firm reflects expected EVA from existing assets and expected EVA from future projects. Impact of EVA on market value is that if actual EVA is less than expected EVA, market value may decline. Even if EVA itself is positive or increasing, it indicates that market expectations significantly influence valuation outcomes. Interpretation for corporate finance, increasing EVA is still valuable even if it falls short of expectations. Delivering some EVA is better than none even if it's below expectations. Then continuing with the relationship between EVA and MVA, we saw implications for high growth firms. In firms with high anticipated growth and excess returns, the correlation between EVA and market value is weak, and market already prices in strong expectations, so small disappointments can reduce value. And investment strategy insight is that EVA based investment strategies must be carefully designed, especially EVA based investment strategy must be carefully designed especially for firms with high expectations built into their stock price, and to avoid overpaying for expected future value that may not materialize. Thank you. So with this we end the session and the chapter which is all about value added, economic value added and market value added as a concept. So see you in the next session. We'll stop for this session because I have been taking one chapter per session in a way, or covering in one session one chapter, so that there is no overlap or confusion in terms of while viewing the session and the chapters during your studies. As I said, always rely on the study material also for deep dive, detailed concept understanding, and more so the problem and solutions that have been solved in the study material, and the illustrations and examples and the question and answers that have been given in the study material. For the purpose of session, I have tried to summarize it in a concise way, simplified way, for you to enable the concept in a short span to help you understand the overall chapter also. So with this, signing off, CACS Pushkaraj Vishnu Joshi. See you in the next session. Thank you.